for joining us today. Just a reminder that we love questions from the audience, so you can start commenting your questions now, or you can also add them as we go. I'll be right back on to welcome our guests to the show. Thanks for meeting us for coffee.
Sometimes coordinating multiple loads, clients, emails, and accounts becomes confusing and tedious. Introducing TIE TMS, the first all-in-one tool that helps you optimize your freight broker processes. You can send and receive quotes, review the shipment status, and keep control of your invoices all from one single screen. It's easy to manage and utilizes the best integrations. Don't take our word for it, our customers are raving about TIE. With TIE, you can improve your productivity by 75%. Go to tiesoftware.com and get a free demo now.
Good morning, everybody. Thank you so much for joining me for episode 40 of the Meet Me for Coffee podcast. I am in Orlando. The sun's actually out today. We had some hurricane complications traveling in, but doing good today. So thank you for joining me and letting me bring my podcast to you guys while I'm on the road. I have a couple announcements real quick I wanted to go over. One, I'm just going to let the cat out of the bag a little early, and we're working on some special edition content with a partnership with TIE TMS, which I'm excited to bring you guys. You might have seen on the podcast channel, or if you haven't, go back and check it on Spotify, Apple, LinkedIn. We've done some special edition episodes with Bigger Picture and Talent Tech and some other technology companies, just trying to better understand when I'm curious about what is this technology? How does it work? Is it something we should be paying attention to? And the views on those tell me that you guys care about those. So I'm actually very encouraged and excited about that. They get quite a bit of traction, and it tells me that you guys like to learn not just about freight markets and economics, but also about platforms that are out there, tools that are available, what other people are using in a way that's a little bit more low pressure than engaging with sales teams. So we are creating some more content, excited to be doing that. And then also, can I feature my own comments? I've never done this before. I'm trying to see if I can do that, but I commented already on the show. There we go. And I put in my links to help you guys save some money for some of these conferences that are coming up if you're interested in going. So the next one will be Trimble Insight. That is in Las Vegas. I'm very excited to be attending that. The Meet Me for Coffee podcast will be there. If you guys are going to be there, please let us know. We will have some opportunities for like an open mic style podcast recording. So my producer, Aaron, who is going to wave at you from behind the scenes right now. You can't see him, but he's here. Him and I are both going to be in Vegas. We're going to be literally, the mic's going to be there. You walk up to us. We're going to get you mic'd up. We're going to let you guys make some content with us, and we're going to get you those short clips. We will be doing the same thing at JOC Inland Distribution, which is the next one in September 30th, I believe, 31st to the 2nd of October in Chicago. We have a 20% discount code if you're interested in heading to that one. Same thing. Let us know. We're going to have some times with an open mic style concept, and we would love for you guys to share your insights and drop some wisdom. This is your chance to help contribute to our content, and we would really appreciate that engagement. And then again, thinking a little bit further ahead, you could save some money if you're looking at that registration for Manifest, which is in February in Las Vegas. And so there is also a code there that will save you on your registration. I believe it's $200 off if you use the link for the Meet Me for Coffee podcast. Please let me know if you're going, even if you're scared to get on a microphone. That's okay. We still want to see you guys. We still want to talk to you. We'd love feedback on the show as well. Okay. Now that we've gotten through some housekeeping things, I'd love to bring on my guest today, Mr. Paul. I can't say his last name, so I'm going to call him Mr. Paul. But Paul, can you please introduce yourself and tell us a little more about who you are and what you do?
Sure. So my name is Paul Poziumschi. It's a difficult one. And I'm the chief economist at Transfix. So basically my background is in financial markets originally, more specifically in quantitative trading, basically using machine learning and AI to generate uncorrelated returns. Now, you might want to ask, what is the connection to freight? Well, I was hired at Transfix to try to apply financial portfolio management models and frameworks to freight and to logistic flows. So there are many aspects of that. I can mention a few. So for instance, starting with predicting the markets. We have spot, we have contract business. And for instance, the contract business can go out 12 months or sometimes 18 months. So it is important to have some predictions of where rates, volumes, capacity, and so on and so forth might be in 6 months, 12 months, or 18 months. So that's one of the tasks that we are doing at Transfix. Then we're running portfolio scenarios. For instance, if we forecast the rates might go to X in 6 months, what is the right approach as a company? Should we focus more on spot, on contracts? What is the relative value, basically, which helps us to better allocate resources to our carrier portfolio and financial resources. And finally, risk management. If you have two loads, each have, let's say, a projected margin of 15%, we have to moderate that by the risk. So if one, the risk to cover it, it's 5%, that's great business. If the risk of the load itself is 20% for 15% margin, it's not so good. So it allows basically to allocate capital and resources in the most efficient way. So now you notice that I'm talking about us in the markets, doing spot, doing contract. This was what we were, Transfix. We were a broker, and we were operating extremely efficiently in probably the worst recession, freight recession on record. Now, we realized that we had a humongous amounts of insights and model that we developed for us to operate in this environment. But those models were generalizable, meaning that we learned a lot more and we knew a lot more than what we could use in our daily ops. And hence, the big pivot at Transfix, we sold our transactional business and we focus now on all this IP that we created, through our years as a real broker. And we focus now on this IP, which is basically data and tech, to provide the same tools to the wider industry. So far, this pivot has been extremely successful. Very shortly, we will have some big announcement to make in terms of who will be some of the next users of our technology and data.
That is very exciting. But I specifically love what you said there when you're talking about that transition. You said that we have more insights. We've built like this infrastructure of understanding markets and insights and application. And rather than just keep that within one company, now you guys have separated so that you have the ability to start sharing more insights, which I think there's obviously clearly a market for, as more and more people are trying to figure out how to understand market dynamics and how to actually not just understand those dynamics, but what do we do with that information and how do we like practically apply it in real time too, and into like what we're doing within our business. Good morning, Matt Selewski. He left a comment. I can say his last name actually. So even though he thinks it's hard, and he said he was also from Transfix. So he's listening in. Thanks for being here, Matt. Thank you for introducing yourself and your background. I know that I have read a report that you published in January of this year. And so you kind of did, I think it was like a 6-month outlook on this year. So we're in month 8 now, but we just wrapped up like the first half of the year and we're moving into Q3. But I'm curious to kind of double back and get your thoughts on, if your role there is helping to understand markets, try to make educated guesses at what's going to be happening. How do you feel like your predictions held up for the first half of this year? Was there anything that surprised you, kind of came out of left field? Was everything kind of as you expected it to be? And I don't want to spend too much time on the past, but just kind of understanding what's happened so far, as I'm sure that might kind of impact where we're headed.
So this is a very good question because everybody makes predictions, but then we need to be held to task. Yes. So I will answer very honestly your first question. How did the predictions work? So first point that I want to make is that we publish our accuracy every month. So basically every month we go back 12 months and we tell you how we perform on 12, our predictions for 12 months ago, 9 months, 6 months, and so on and so forth. So currently those numbers, which are the mean percentage error, how far our predictions were from the market. Whether you look at 1 month, 3 months, 5 months, 9 months, they are all within 1%. Meaning that if we predicted markets 9 months ago, the current number, the realized number is less than 1% away from our prediction. So I would say that on balance, our predictions were very accurate. I would also not give myself much credit for that because I want to explain what our predictions are, because we have a very different way to predict from what, let's say, the economists call predictions. So we don't study inflation, unemployment, capacity. We look at those all together, but the prediction is very much data-based. And what I mean by this is that we're looking at every single zip to zip line and we forecast these 18 months forward. So we're looking at the granular trends in the data and the momentum that they have. This is not as much a prediction as an extrapolation. We're reading basically where the data is going. And there is a significant amount of insights in the granular data, the capacity increasing there, decreasing there, rates moving across the map. And therefore, a lot of the accuracy that we get is precisely because we do not formulate guesses. We just extrapolate those data trends, those granular data trends, and we aggregate them. So we start with each lane, then we look at a city, a facility, a region, and obviously we publish what you saw, a national forecast.
Yeah.
But the national forecast is at the end of the process, right? Now, have things surprised us? To an extent, yes. So what hasn't surprised us was the fact, what we believe to be the driver of the market, which is the capacity. Capacity is decreasing at an accelerated rate. So if you look, for instance, at ACT fleet capacity, the numbers have been negative practically every month for a year since July of 2023.
Right.
And the employment numbers tell a similar trend, although milder trend. The biggest story here is that capacity is leaving the market, especially small operators, but not only. We heard some big names that exited the market as well. And this capacity, as it exits the market, eventually will rebalance it by meeting the current demand. This extra capacity is obviously the capacity that was built post-COVID. So we are returning to the trend. Now, what we said in January was that we thought that within a couple of quarters, capacity supply will start meeting the demand. What surprised us was that that convergence was a little bit slower than what we expected, meaning that right now we're still probably more than a quarter away statically from those two curves meeting, meaning that the market has been a little bit softer than to adjust, on the big aggregate supply and demand than what we thought. The reasons for that are multiple, and I think we can talk about them in some level of detail. The economy is decelerating, to put it mildly. Manufacturing, which accounts, as we know, for maybe, 2/3 of land freight, had some mildly positive trends in May and June, but July we got a stinker. For the first time, the ISM dropped under 50, which is a recessionary warning.
Yeah.
Consumer confidence, which is something that we also monitor very closely, started to drop significantly, especially, the consumer confidence has two aspects: expectations, which kind of are hovering at low levels. They have done that for a while. And then the present situation. Well, the present situation was fairly resilient. The US consumer was somehow staying optimistic about today. That changed lately, and it's dropping off the cliff. So between the consumer, the factory orders that plunged tremendously in June, I believe is the biggest drop since COVID, manufacturing in general, well, that lengthens the process of healing in our industry. And despite the fact that we've been already in the biggest recession on records, trucking recession, I'm talking, we still struggle to rebalance the market. And therefore, the path that is slow to recovery has been even slower than what we expected it, and we were not very optimistic.
Yeah. Man, you're making me, I need to go back and requote myself here soon. Because I think in the beginning of this year, I wrote about how, if we do this something like a soft landing or even a no landing, it was going to be low and slow is what I called it. It's going to take longer. And I think that that's what we're seeing, because this is why, in my opinion, this is why this podcast exists, to talk about macroeconomics, but then to talk about the freight market and how these two things are meeting, because the economy has actually been in a pretty good place. And so in freight, we're oh, volumes are down, rates are down. It's been so hard for now over 2 years. It's going to change. Everybody's it's just time to change. But the scary thing is the economy was actually in a pretty good place, and it's starting to cool more than it has been. So you said, consumer confidence, manufacturing, we're not seeing signs of returning strength right now. Now that brings me to another question I have, and we're going to lead right into this. To be honest, I don't think I've heard the word recession tossed around by economists since maybe January. And it was mostly about we're sticking the soft landing, we're getting out of this, we're fine. I don't know what happened. I think I think I know what happened. I'm going to guess it was correlated to the unemployment rates releases last Friday. Stock market had 1 day of nobody knew what went on, all of a sudden, and for a 24-hour period. I guess we'll see if that continues today. And then everybody just kind of was next thing I know, I get on my phone this morning and all my news articles I subscribe to are here's the strength of the labor market. Is there a recession? What are the risks of a US recession? And it's we weren't even talking about this for the last few months, but now we're back to talking about it. And so when we're sitting here saying we're going to come out of this freight recession, everybody's I feel it, we're almost there. And now the economy is talking about recession again. And I haven't seen a consensus that we're going into one. I'll be honest. Most of the people I'm seeing are talking about it because they're saying, no, there's not going to be one right now. Like, we're not doing that. But it has to be said again, which carries some weight. That means that there's indicators that cause people concern about the health of the economy. And that's why we're talking about recession again. So what are your takes on this? You wrote in your January article, you mentioned like a report around the risk of a recession. You put it as very minimal. Where are you at now for the next, 6 months or a year? And what do you say about that?
So you're raising two critical questions. And I want to come back to the first one about tracking recession against economy recession. And this is something that's very that's basically driving tracking markets at the slow pace that you mentioned. Well, tracking has been in a recession for more than 2 years. I believe J.B. Hunt talked about tracking recession during one of their earnings calls or some conference. I'm not really sure. They named it about 2 years ago. And we can consider that was the case. But the tracking recession was driven by the COVID excess. So at the same time as the tracking recession, it's again equalizing supply and demand. We are coming to pre-COVID levels. We are aiming for this. We might actually face a real recession that will lengthen the tracking recession. This is what's at risk here. Yeah. In terms of economics, I mentioned, you're right, I mentioned the odds of recession in the previous report, saying they diminished, right? They right now, obviously, a number of factors have kind of changed the consensus about where we're at economically. And as you mentioned, and I think it's probably the main driver right now, is the employment numbers that we had on Friday. It was a massive miss. We had 114,000 against, I believe, the consensus of about 175,000. And especially the employment rate that hit 4.3%. It was expected to stay flat at 4.1. Now, this is only the kind of a high level view. What is more worrying is when you look into details. So for instance, temporary help employment and quit rates are flashing outright warning lights. And vacancies, for instance, have dropped tremendously since 2 years ago. We had about 12.3 million vacancies. Now we're down to 8.2, right? So that has brought something that was only an economist, something that only economists talk about, the SOM indicator. The SOM indicator is basically an indicator created by a Fed economist, Claudia Sohm, and it's looking at how the momentum in unemployment to predict recessions. So it's over half a century has a perfect track record. And if you believe it, then we are aiming for a recession, okay? So everybody, it's now starting to question this. Financial markets are panicking. The Fed is now priced to cut rates in an emergency meeting next week, and so on and so forth. But I want to weigh those things. First and foremost, Claudia Sohm, who created the index, pointed out that just like in tracking, the employment market has seen something unprecedented with COVID.
Yeah.
So even if you look at 8.2 million vacancies today, even if the drop is significant from 2 years ago, this is still higher than pre-COVID. So we are in no, I'd say, immediate danger.
Sure.
That being said, there are some signs, as I mentioned, that are worrying and accumulating, meaning that, for instance, Goldman Sachs raised their odds of recession from 25, I believe, to 30. I think this is probably a little bit optimistic. Even though a recession is unlikely in statistical terms, I think the odds of a recession are much higher than most of the economists are accounting for. There are too many warning lights at the granular level. We mentioned about the consumers, we mentioned about manufacturing, but even if you see, for instance, earnings like Amazon's, they have a significant predictive power. And again, the data, the granular data of unemployment, I think we could see a recession with odds that are probably way above 30%, maybe closer to 40%.
But would we be seeing that in 2024? Or are we talking beyond?
Good question. The indicator is a predictor of about also a quarter or two. And likely, if we are going to see a recession, it will be in a relatively short term. Because what's at stake here is that inflation is on a downside, but the Fed still doesn't have enough confidence to cut very aggressively and very quickly. So what we are speculating about is that the Fed might be marginally behind the cycle and adjusting too late. And by that time, we would have shifted in a recession. So likely, if it happens, it will happen in a very short term.
Yes. And I remember now conversations from earlier this year when we talked about the risk of a recession, this year, or even now, maybe early 25. I remember some people talking about if we do go into a technical recession, there's a chance it would be shallow and more mild than what we've seen in the past, and that it would actually create a stronger recovery, a faster recovery. Now they were saying, I actually think they were saying if we go into a recession like early 24, we'll get it over with and we'll have a greater recovery instead of this low and slow. But now it's like, okay, well now we've had the low and slow, but are we still going to go into a recession? So if we do so at this point, would it still be shallow and mild? Or would now we maybe be stuck for quite a while longer because we didn't just get this out of the way a year and a half ago?
So this is the $1 trillion question. My personal experience, having been around for some times in the financial markets, is that once we get into a recession, the pattern of the recession is extremely difficult to predict.
Right.
If we could slowly move into a recession or a slowdown or cooling down or whatever we might want to call this, we could probably avoid it. We would simply manage the cycle softly enough, the famous soft landing that the Fed is supposed to deliver. But in reality, when we enter a recession, there are a lot of self-fueling processes that can take us much farther than, the Fed or the economists are comfortable for. So I think it's very difficult to predict the shape of the next recession if we enter one. What I would say is that the pressure in the system is significant, and we can talk about a number of interesting factors, including debt, that would probably take time to resorb themselves. So I do not believe that we're going to have a soft landing that will simply transition us towards another period of growth. That's not to say that the recession would be on par with 2009. Nobody knows. But if we enter a recession, it is likely to be a fully fledged one.
Okay. So I have another question now that I've never, I'm thinking through this in my brain, like in real time, because I haven't thought of it before. So I'm going to ask you. I have a hunch, but typically when we are in a lower market economy, like we are not, people don't expect the freight market to do well. So the thing is, though, we've been in a pretty stable economy for the last couple of years, and the freight market's not been doing well. Yes. So if we go into a worse macroeconomy, is there still a chance that freight somehow finds some type of a high market cycle? Because what I'm thinking now is it will probably hurt even more for a while, but I think we're just going to run out of capacity. And then we're going to create an imbalance. So even if we stay in a recession in the macro economy, can we still see the market change in the freight markets to where there's pressure on rates again, because we just lose that last bit of capacity that's been hanging on, and we finally have done that. Now, I asked this skeptically because I've had some gentlemen on the show before. I know Jason Miller will say that we've never exited a freight recession without a supply stimulus. So is it possible to exit a freight recession strictly because of a demand exit, or I should say, supply exit? I flopped those. A demand stimulus. That's my question here. Because I feel like,
yeah.
again, I think I'm taking this like we are in uncharted waters. And that's kind of one of these things where people don't know, because this has been such a different economy and freight market coming off of such an unprecedented time as COVID, that now I feel like I'm asking questions that like we haven't had to consider before.
So I find Jason's analysis extremely informative, and I'm an avid reader of everything he publishes. Now, his general, if I understand well, of course, his general just is that manufacturing is what will take us out of a recession by and large.
Sure.
And manufacturing is struggling. So as long as we don't have demand picking up in a significant way, that this trucking recession will keep going on. I actually side with your view. And we had a webinar in March where we discussed exactly this subject. Meaning what? Meaning that for now, as I mentioned, for a year, we started bleeding capacity at an accelerated rate. Mm-hmm. Irrespective of what happens in the economy, sure, supply leaving the market will rebalance the market. Now, if you're telling me that the demand is going to fall off the cliff, that we're going to leave another 2008 crisis over the next year, all bets are off. But sure, in practically any scenario, given how fast supply leaves the market, even if we enter a recession in the economy, we will still restart the process. The rates increase faster than the economic cycle that will bring the recession. Because again, we are 2 years ahead of the cycle. We entered recession 2 years ago. So we are not aligned to the economic cycle. We are adjusting for the COVID spike. Yeah. So my view is that you can lengthen, and certainly this is happening as we speak. The recovery, it's slower than we saw it happening in January, for instance. But at the same time, the adjustment continues, the convergence continues. So maybe instead of taking 2 quarters, it might take 3 quarters. Mm-hmm. But at the same time, supply on its own, we believe at least, will rebalance the market. Moreover, if we enter a recession, what will happen? All the weaker players in our sector will leave in droves. Mm-hmm. All the people that have waited with a little bit of reserves from the period of COVID are going to run into trouble at an accelerated rate. So the supply would accelerate. In my view, in almost any scenarios, bar obviously a macroeconomic event of epic proportions, wars or huge financial crisis, we are on the path to recovery. It is very frustrating that it takes so long, but trucking is on the other side of the hill. But as you know, the end of the tunnel is typically the most painful as well. That being said, I agree with Jason that manufacturing has a tremendous power. And obviously, if manufacturing picks up, it will completely change. We will get that much faster. But in a way, a recession might simply accelerate the supply destruction faster and get us faster into some sort of balance between supply and demand.
Right. Yeah, we're still sitting at an oversupply. So, I mean, when that capacity finds its balance, typically then we would say, okay, it finds its balance. And then there's that demand surge that creates the imbalance again moving up in a positive way. I think what we might run into, it sounds like, is we find that balance. And while it won't drive rates up dramatically, it will at least hold a new floor, a new threshold, because you will start to see, maybe if you're a shipper, those tender rejections go from only 2% to, 8%, 9%. And you might feel a little bit more strain there that help to hold those rates a little bit more of a higher floor than what we've at least been at. But I just think like we would be in that situation. Like you said, we would be en route to the recovery and moving upwards. But I think that we wouldn't see like this dramatic spike throughout the recession. At least that would be like my take on this until we get some type of stimulus.
I would entirely agree.
Okay, cool. I'm glad I asked that question. I was like, I'm going to say it because I'm thinking it. So the last thing I wanted to ask you, I'll do a two-part question. I've been thinking too while we're talking, there's a lot of unknowns right now. We've said that. Do we know what the recession will look like if we go into one? No. Do we know when we're in it what it's going to be like? Maybe not. But I think that's something that I've kind of been telling myself is markets don't like uncertainty. And I feel like we've just been in a lot of uncertainty lately and having to be like, well, is it going to be like things we know previously? Because we have no context for this. We can't compare this to something. And so I think that consumer confidence, like you mentioned, kind of waning a little bit. I think people are just a little bit concerned and frustrated at this point. And so then they're going to see your average consumer who isn't studying economics. They're going to see the headlines. They're going to see unemployment go up. And we're in a politically charged environment right now. So things are also being manipulated a little bit, right? And exaggerated because, of course, unemployment going up is great for one party, the opposing party of the one that's in. So we're going to be seeing this happen. And I think that, right, wrong, or indifferent, that will impact kind of people's confidence in the economy. And we'll start seeing people have to address recession again. That's why I'm seeing these articles, because the economists, even if they think like we're not going in one right now, they're still going to have to address it because they understand that there is like the average consumer and the average U.S. citizen right now is concerned. And so I will ask you this as we close. I'm from Kansas. The Kansas general election is today. So like thinking about elections and things like that. What does this upcoming presidential election mean for freight and the U.S. economy? We have about a couple minutes to answer this question, but love to get your high level thoughts.
Yeah, so high level, you can focus on the short term and say, well, Trump runs on low tax, low regulation, some form of economic protectionism, which possibly is good for manufacturing, going back to, Jason framework. So good for business program. At least this is how the markets perceive it. So in a way, you can say that the Trump win might boost the economy and create more demand for the trucking industry. On the other hand, though, if you look at Harris, she's likely to continue Biden's policies or legacies. There will be no tax boost or lower regulation, but there is an increase in public spending, also possibly boosting the economy, more stimulating the demand side. Yeah. So, frankly, at face value, I am maybe psychologically, Trump is seen as more pro-business and therefore would improve business sentiment. But on paper, I'm not 100% sure that either program would be significantly different from the other in terms of what will happen in the trucking industry. More importantly, they are very similar in another way. Neither candidate seems to bother about the national debt, which is reaching 35 trillion. Right. Or at least certainly their actions, if we look at the Trump term or Biden terms, don't account for it. So maybe the interesting question is, if we continue on this path, especially as the Fed is preparing to cut rates, maybe as soon as next week, at what point this creates an issue for debt refinancing in the US? At what point investors, especially foreign investors, will require a higher rate of returns for the embedded risk? And what will be the consequences of that on the economy at large? Because we are panicking now that the Fed is not cutting rates quickly enough. Well, what if rates would stay high simply to keep, investors in U.S. debt happy? So in a way, I think the consequences are more long-term than short-term. I don't think the election will matter tremendously in the very short term.
Yeah, great insights. And I specifically love the part about like either way, not much changes for us, which I think is always something that's almost entertaining around elections, is that it's like, yes, that's probably it. We think the results are always a lot less dramatic in the 4-year term or whatever it is than people maybe anticipate going into it. Okay. as we wrap this up, Paul, any just thoughts, advice, forward-looking predictions, things people should maybe pay attention to, or any last thoughts to share with the audience? And then also let us know how people can get in touch with you if they have further questions.
So the most important thing when you have a lot of dispersion and volatility in any markets, and certainly in the tracking market, is to focus on the data. And it's not only because we are a data and tech company overall. For instance, when we talk about the national forecast, for instance, is a very poor predictor of what happens in every single region. We ended up in the US with several tracking markets. So don't trust, for instance, the national prediction for your budget and for your forecast at lane level or regional level. So paying attention to the data becomes critical because capacity reduction is not uniform across the map. Economic opportunities are not uniform across the map. The South, where you're at, is now seeing a huge boom of business. The Northeast, for instance, in California, far less. So there are a lot of I would say regional and even sub-regional events that are now driving rates, capacity, availability, and so on and so forth. So pay attention to the granular data, and that would be my lesson for anybody operating in a tracking market, because there will be a lot of insights, particular insights, and they will make the difference between people who will thrive or even survive and those who won't.
Yeah. Awesome. How can people get in touch with you, Paul?
So they can contact me at Paul Poziumschi at transfix.io, on LinkedIn.
Yes. And if anybody, we didn't get any questions. Everybody's always hiding, and I had to ask, the questions today. But if anybody has any questions, or you listen back and you have questions, please feel free to come back to the LinkedIn live event. You can find it featured on the top of my LinkedIn profile for a while, and leave your comments, leave your questions, and tag myself and Paul in those. And we're happy to, share some thoughts in those, or reach out to you guys and answer those. But we'd love to get more questions. We got to get people to start asking and speaking up. But trust me, I asked a question. I thought I might sound stupid asking, but I'm glad I did. So we'd be happy to answer any of those questions if you guys have them. Come back anytime and drop them in the comments and just tag us. We'll get to those. That's all we've got today. Thank you so much, Paul. I really love this conversation. I love conversations when I don't have to talk a lot, because it's that good. So I feel like I did a lot of listening and learning myself today, and I'm very appreciative of that. I will be also putting some cliff notes from this episode into the Truckload Market Update Report, which we'll publish this week on my personal page. So thank you again for sharing your insights. And thank you. Thank you to everyone in the audience for meeting us for coffee.